Good morning, everyone. When I picked this topic, some dear friends and clients reached out and said, are you sure you want to do this? Firstly, this topic is rather picky one. It's a rather thorny one. You're like the bringer of bad news. You've been speaking to lots of people about USTR this year, and people are starting to know you as the bad news guy. And they said, how do you know whether or not when you wake up on the morning of your presentation, the fees are going to be in effect, or whether they're not going to be in effect? Because we know whether or not the fees are in effect depends on whether or not President Trump has gotten off on the right side of the bed. So I said, that's pretty simple, guys. I'm going to prepare two speeches, speech A and speech B. Speech A assumes that the port fees are in place and that doom and gloom is in place. Port B talks about the pause. And so today, when I woke up in the morning, I looked at the news, made sure that the port fees were still suspended, and I picked up version B of my speech and I brought it here today. Yep. So yeah, without further ado, let's dive into the presentation. So it's about the port fee standoff. It's a truce, not a treaty. So instead of discussing a life crisis now, we're going to use this new breathing space to do something a bit more valuable and meaningful. We're going to look into forensic analysis on the market's reaction, introduce new data on the staggering financial impacts of the port fees, and chart the strategic course for the year ahead. Yep. So in a nutshell, this is what the port fees were about. I'm not going to list out the fees, the various tables involved. I think everyone is very well appraised of what these fees did. So it's a complex system of port fees levied against different types of ships, practically all classes of ships calling at US ports with a China connection, whether related to a place of construction, ownership, or sometimes even finance. So China's reaction was to impose a retaliatory fee, which was pretty much a mirror of what the US did, with certain exemptions for Chinese-built ships. So what happened was the presidents came together, they had a talk, and they agreed on a one-year pause. So what we realized about this pause was the US came to the table rather readily and agreed this pause in the context of what we know to be a US government shutdown, which means that quite a lot of the CBP employees were furloughed, probably unable to work, not willing to work. And this essentially hampered the collection of the port fees and the enforcement of the entire framework. So rather than what we call a very kind concession by President Trump, we are wondering whether or not this might have been a form of a necessary concession, giving to the US something that they couldn't already, US giving concessions to China on a scheme that they couldn't actually properly enforce in the first place. So that's something to note, that this suspension actually occurred in an environment where the US might have been unable to properly enforce the framework. Whether or not this continues to be a consideration a year from now, we don't know. There's every possibility that the US comes back stronger with a larger CBP department, with a more sophisticated framework to trace, investigate ownership, chains, origins of construction. So we have to be prepared for the worst. So the next few slides talk about the reality of the port fees when they were in place for these brief 2 weeks. So what happened was an immediate $40 million plus financial impact on the top Chinese carriers. COSCO and OOCL handed out to the USTR roughly over $40 million in fees during that period. Matson was a lot less incurred, but it was notably one of the headline companies which faced the fees, paid the fees to China, and they were vocal leader in industry lobbying, which probably also led to the pause in the port fees on the US side. So what we see over here is also a form of bifurcation in the market arising from port fees. And we also saw a bit of a volume drop-off during that period as well. So the key financial impacts were you had a bifurcated charter market, or some might even argue a trifurcated charter market, because you had a clear premium which emerged for unaffected tonnage. So the news reported a premium where early reports indicated 5 to 10% day rate premium for vessels deemed clean and free of US-China tariff risks. These were vessels owned by foreign ship owners who owned non-Chinese flagged, non-Chinese constructed vessels. You had a bit of a drop-off in US calls as well. AI data showed a 3 to 5% decrease in vessel arrivals from China at major US West Coast ports. And clearly, what caused this drop-off was the $40 million plus liability for Chinese carriers. We saw this as the direct driver for the market panic and bifurcation. We talk about trifurcation because there were various tiers of port fees, some of which were more expensive than others. The Annex II port fees related to the to the vessel's origin of construction and were levied upon Chinese-built ships. There were certain exemptions, there were various wide-ranging exemptions that actually lessened the impacts of the Annex II fees. The Annex I fees were the larger fees by far, and they effectively targeted China ownership rather than China-built tonnage. So when we talk about trifurcated market, you have at the very top a premium being paid for unaffected vessels, and then you have your Annex II vessels, which commanded a slight discount by virtue of the fact that smaller port fees were payable, and then the Annex I affected vessels, where essentially very significant port fees were payable. And when we talk about charter day rates on vessels of these three classes, we saw a rather clearly defined trifurcated market arising as a result of the unaffected class, the Annex I port fees, and Annex II port fees. So now the battle has moved also to the charter party. So we are seeing a battleground between owners and charterers here. On the right, if you look at the slide, we see a sample USTR clause which appeared to us 2 months ago for the first time in an email recap on a time charter between a Singaporean ship owner and a charterer from a North Asian country. So I can't reveal the identities of the parties, but in a nutshell, this was essentially how the USTR clause went. So it reads, the owner warrants and confirms that blah, blah, blah shipping is a Singaporean company. Should USTR 301 regulations be implemented on Chinese financing, ownership, or construction that incurs USTR 301 fees on the charterers, when the vessel calls in the USA, then this will be for the owner's account. Now, clearly, this will be drafted in a more sophisticated fashion when it finds its way into the actual TCP. But this shows, in a nutshell, how charterers have attempted and are beginning to shift the USTR port fees over to the owners. Now, this 1-year suspension is a great opportunity for spot owners to continue their trade. But how about the owners which operate a different model where they essentially purchase vessels and they time charter them out on long-term contracts to international charterers? It depends really on your business model. If you're a spot trader, this 1 year represents a very, very welcome opportunity and gives you quite a bit of breathing space. But if you are an owner that purchases vessels and time charters them out on a long-term basis, then your headache hasn't gone away, because you're signing a time charter contract potentially for 2 or 3 years on a basis of a 1-year pause. Now, if that clause finds its way into your contract, which is a 3-year time charter, a year from now, if your time charter party has not specified trading limits to exclude the US, then you might very well find that the charterer has a contractual right to order the ship into the US, where you will be paying millions of dollars in port fees. So for owners that enter into long-term time charters, the headache simply hasn't gone away. The 1-year pause, it's a good to have, but it doesn't really doesn't change the needle, doesn't really move the needle. So it depends really on the business model, but what we need to do at this point in time is, as ship owners will need to assess the exposure to the USTR. It might not even be a 1-year pause, because as I mentioned before, and as some practitioners have pointed out, the US has currently agreed to a year pause, and that might change anytime if Trump decides suddenly he's in a bad mood, he's decided to lift the suspension. We might actually have a bifurcated or, we might have suspension that's been cut short. So we do have to be careful, and we do have to be aware that policy change is fluctuating, is liquid, and might change at any time. So now what we have to do is develop a 12-month action plan, a 24-month action plan, probably a 36-year action plan. We need contractual clarity. As ship owners, you need to look into your contracts, service contracts, time charter parties. You need to vigilantly negotiate charter party terms, especially if you are a ship owner entering to long-term time charter parties, or if you are a ship owner looking to enroll your ship into pool agreements, for example. Will your ships be allocated fuel points should your ships be affected by USTR? Are these clauses finding their ways into pool agreements? Financial modeling. So there are various ways, I would say, that parties have looked to mitigate or legitimately avoid the effects of USTR through joint ventures, through debt equity structures, through orphan trusts. But if you cannot avoid these effects, or if policy restrictions have prevented you into exploring alternative structures, then you have to engage in very rigorous financial modeling, stress test your cash flow against financial impacts of the port fees and the potential for absorbing these costs. So it might very well be that you've gotten very favorable rates on your financing. Might have been that you've purchased very cheap tonnage at very good prices, such that the port fees actually don't destroy the business model, don't destroy the business thesis for investment in China. It might be. But if you've entered into more expensive financing, or if your tonnage has been purchased at an average price that doesn't make the port fees viable, then you need to replan your operations, possibly do a more Asia-centric, more Europe-centric trade, avoid US ports. So there are various different vessel deployment strategies. There are essentially ship owners that have entered into what I sometimes describe as almost like code share agreements that airlines have entered into in the past, where people share tonnage, share passengers on a code share type of arrangement. These are rather interesting structures which can be explored with international unaffected ship owners as well. And more importantly, prepare for real enforcement and assume that CBP might be fully ready to enforce within a year. So legal structuring is something that's is rather dear to my heart as a lawyer. When the port fees came out in April, I started brainstorming. Many of us as lawyers started brainstorming, thinking about various orphan trust, lease in, lease out structures. And one thing we noticed is that these port fees are actually nothing really new to enterprising ship owners. Over the course of history, many countries have implemented cabotage requirements requiring local content, local joint venture partners before international partners can venture into local shipping spaces and perform domestic trade. And very often, the source of capital comes primarily or even exclusively from these international investors. So how have these international investors overcome these cabotage requirements and invested into local markets to apply local cabotage trades? There's been a variety of structures employed across the world, in Indonesia, Malaysia. Such restrictions and prohibitions are designed to shut out foreign investors or confine them to minority shareholdings. But through carefully planned structures and commercial arrangements involving a mixture of debt and equity, we've seen foreign investments time and time again develop ingenious workarounds, synthesizing the commercial and financial effects of full ownership and control, despite on paper being minority owners. And the answer often lies in legal structuring, often involves an injection of money, partial injection of money by a foreign joint venture partner. But what we have seen is that pure legal structuring doesn't always work, because what we want is a solution which attracts as little attention as possible. And if a regulator should ever come across this structure and pry the floorboards, look below the floorboards, what they'll see is a legitimate structure which withstands the rigorous scrutiny of a regulator. So it must be unassuming, it must fly under the radar, and if it's ever detected, a regulator must give it a clean bill of health. So if anybody out here has been affected, would like to explore some structures, legal structuring is always a good idea, have a chat with us. So the key takeaways from today's presentation is that the suspension is a temporary relief. It's influenced by unique enforcement handicap due to the US government shutdown. The financial impact was catastrophic, really, with $40 million incurred by Chinese owners in just 2 weeks, and we know this is not a sustainable penalty for the Chinese shipping industry to pay in the long run. So the risk is already being priced into the future via USTR clauses in multi-year charters, and this creates long-term liability for owners, particularly owners who have a business model which involves long-term charters. In fact, what we have in financing is often the bank requires that long-term charter with a strong credit party sub-charterer, they very often have that as a condition precedent to their financing. So for many such ship owners, the headache simply hasn't gone away. This one-year window is a gift of time that must be used for aggressive contractual and strategic preparation, which involves legal structuring, legal negotiations with charter parties, and essentially careful planning and consideration in structural, operations, legal planning. So proactive planning today is the only defense that we have against a well-enforced, financially devastating re-implementation within a year. So I'd say hopefully we end off this presentation on an optimistic note. We see that the US is coming to the table, trade relations are warming, parties are willing to negotiate, and at the end of the day, 301 investigations ultimately do go away. They do take time, but over the course of history, we've seen that most 301 investigations are temporary and within a few years get lifted. So I would say to end off this presentation on an optimistic note, we know 301 isn't going to last forever. These fees aren't going to last forever. And if you plan well for the future to mitigate against the effects of these fees, we'll all emerge stronger, and ship owners in China will find business as usual in a few years. Thank you, everybody.